So today I'm joined by the president and co-founder of Vox Funding, Lou Calderone. Lou, thanks for joining me today.
Thank you for having me. I'm so excited to get started, and you've had such good reputation in the industry. I wanted to be part of this.
No, I appreciate it. No, thank you so much for those kind words. We're going to get into the MCA world, revenue-based financing, a lot of the things that you guys have been working on in 2025, what's ahead, kind of the things that people have been talking about, regulation, AI, the market right now. So let's get started with, what are you seeing? I mean, because you've been operating now through several market cycles, right? You've been in the business for a while. So operationally, what's the most meaningful way the MCA business has changed in the last couple of years?
We have been driven more by the data now than ever before, right? The data that you accumulate over years and years of funding merchants has now come into its maturity where we make decisions much faster and much more succinct.
And is that, because speed, right, has always been one of the MCA, the revenue-based financing, defining traits, right? So at Vox, how do you think about it today? I mean, speed, and then where does it really become a liability for you, if at all?
So I think the liability is when we receive a submission from a merchant, we only receive a limited amount of that data, right? So if you make your final decision on what was presented and do not follow up with additional questions or additional documentation, that speed is really difficult to sustain. So it is a matter of making decisions based on the data you have and getting the additional data you need to make your final underwriting decision.
And talk to me in reference to fraud then, right? You're catching things, obviously if you're going too fast and you're missing things, then there's a chance that fraud somehow, something along the way slips through. How do you, almost like a quality control aspect of that, right?
So we at Vox do use a few tools to eliminate that as much as we can. One is we use Plaid, Decision Logic, or if those two fail, we use a bank login. We match up what was delivered to us on the primary submission to what we receive after the fact when we have the merchant on the phone. And we match up deposits, withdrawals, check numbers. We ask a few questions about deposits that seem larger than usual or really small or out of sequence. So we try to catch the merchant or catch that person on the phone through questions that are meant and designed to trip them up. If something doesn't look correct, it's probably not correct. So we ask those questions along the way. And that's how we go through the fraud process.
Yeah, and it's a great point because if they are the merchant, right? One, is it really the owner? Is it some employee or someone else that, ripped off their identity? Or two, now with AI, you can get actual bots essentially trying to conduct a phone call with a funder like yourselves. And you got to be wary of that as it gets better and better.
That's correct. And in the underwriting process, not only do we look at bank statements, we rerun backgrounds through multiple channels. So there are always questions that we can ask, not unlike when you log into a bank and they ask you your mother's maiden name, right? So there are always questions that you can ask along the way. Bots might be helpful to them but there is enough data that's hidden from the bots that you can keep going.
Okay. Yeah, good to know. And so when people talk about risk and MCA, again, I always like to, give out the other names of it. Revenue-based financing, sales-based financing, all pretty much the same. They usually mean defaults as far as risk is concerned. So from an operator's perspective, what risks actually keep you up at night?
That's a great question. What really keeps me up at night on the risk of default is the merchant using the money for the right reasons? And some of the merchants that we end up funding have the view that they're taking the money for the right reasons, but in actuality, they're just filling a cash gap, okay? And it's really dangerous for them and for us, right, when they're using that money inappropriately. We all know that this is not a bank line of credit, that is not a bank loan, okay? The rates are way different than that, but used appropriately, it is a good product, but the merchant's got to understand understand that they're going into a situation where they got to pay us back based upon their revenue. And when things change with them, things just go bad. And that's what really think. If they use it to expand, buy a new truck, buy inventory, buy a new table, whatever they need that for, and their revenue goes up, those are great. When they're using it to pay their payrolls, they never can sustain that. So that's what's really frayed, is the explanation from the channels of submissions and getting to the merchant, having the merchant understand what they're using the money for.
Super important. And so along those lines, right, a customer performs, they pay you back fully. Now they are up for renewal, and they take renewals. And, these repeat merchants, they're often a sign of success, right? Funders and brokers alike want renewals. They want that merchant to keep on coming back to them. They're growing their business. And so what do those merchants that are renewing consistently tell you about your company, your service level that you provide them?
So we're really proud of the fact that when the merchant calls in and says, hey, Vox, I got a small issue for a week or 2 weeks or a month, and we understand that issue, making the accommodations that we should be doing, and get through that bumpy period of that merchant. Then when they come for renewals, we don't hold that against them, right? We're like, that was a really good merchant. Now, their revenue went down, our payments went down, that extended the term, okay, or the estimated term by whatever dates and time that is. But that to us is a good merchant. We pride ourselves in picking up the phone, understanding the problem, resolving that problem, and moving forward. Those are the merchants that typically renew with us, okay, because they had that one blip and they came to us and we knew exactly how to handle that and move forward.
So changing gears a little bit, there's regulation that has been going on for the last several years, and some of it this year, some states have passed some regulation that is very impactful. And now there's a public perception of MCA and revenue-based financing. From where you sit, what do people still fundamentally misunderstand about how this product is actually supposed to work?
The biggest misunderstanding about the product is we are purchasing a percentage of your future receipts. And we are not taking the amount that you can afford. We are both agreeing to the amount you can afford. So we come to an agreement, we purchase 10% of your future receipts, and then let's just call it $100 a week, okay? If you're having a problem, you have to call the funder and say, hey, Mr. Funder, I am having a problem. My obligation to you is $100 a week. My revenue has come down by X percent. Now my payment to you is only $52 a week. And that smooths out the problems that the merchants are having, right? This is not a forced loan payment where it is exactly the same, and no matter what you're doing in your business that day, it doesn't impact us. It does impact us, right? We are contractually obligated, okay, to change those payment structures to meet the contractual demands on both parties, okay? We are providing capital in a path that is reasonable when used appropriately, and we have to make the changes when appropriate. And I think what the world perceives as MCA as a predatory lender, we are not lenders, by the way,
right.
A predatory lender that is pounding on your door when you miss a payment, or pounding on your door when you call and demand some reduction. That is not the case with most funders. Most funders are more than accommodating to the merchants. We go by the rules that we've determined. We follow those rules. And most often, even in court cases, when we go in front of the judge, we have met our obligations. The merchant is the one who doesn't usually meet the obligations. Usually the funders do.
And yeah, I think it's a combination of a few things. The merchant, one, they have to understand that they have that ability or right, and they get hesitant for whatever reason because they think bad things will happen if they call you and ask for a reduction because their sales are slow for whatever reason. So I think that's that hesitation that needs to be hammered to them. They have to call you. That's don't go quiet and not pay. Right. And then two, you have that relationship with them. So it's that one kind of position, right? That's kind of the lingo that we use in the industry, but that one advance, that one MCA, and then the issues a lot of the time, if not most of the time, happen that when they take more than one, right? Because then now the combination of all of them are taking a higher percentage of that income, those sales for the month, right? And so when you are, providing them a contract for 10% of their sales, monthly, and then it goes up to 20 and 30% because of multiple positions, that's where their cash flow is really hurt. and not that you approve that, right? Like you aren't the one that approved that.
That is true. We try to look at the merchant's needs and ability to pay. If we say no to the merchant's ability to pay, the merchant gets themselves in some situations where they're desperate for the additional funding and they figure it'll all work out in the end. And what usually happens, it doesn't work out. Now, we would always take that phone call, always try to work that out with that merchant. Even if we try to direct them away from doing that again, we feel some obligation to the industry to try to help the industry as a whole, right? And not bring a bad name to it. So even in situations where we're a first position or a second position and the merchant comes back through the process and has 5 other positions and says, I need help, we help, right? We don't ignore the fact that we have an obligation and we try to help that merchant even though they've made some bad decisions.
Okay, well said, right? And I think that hopefully should be the mentality and service level that other funders give the merchants to help them out. All right, so in kind of wrapping up here, do you think the MCA space is actually becoming more competitive or more selective?
That's an interesting question. I think both. And then let me explain. I think is becoming more competitive, that more people are seeing a business that has an easy entry point, but more selective as the cream is starting to really rise to the top, where the top 15 or 20 funders really are dominating the industry and really driving what's going to happen. Major pricing, terms, helping on the regulatory process with lobbyists and people sitting in rooms with senators and state senators explaining exactly what this product is, not some rumor about some loan shark product that's out there in the world and everybody's jumping to. So I think the selectivity will continue. I think the good funders and the top funders will continue to rise. And I think there will always be newbies on the horizon. But as regulation starts to really come into play and we start to look at a change of what we are as funders are required to do, disclose, I think the smaller newbies will be less and less. So right now, I think it's still open, but I see it very soon being much more selective.
Yeah, great points there, with the regulation and combination of other things. With 2025, just about ending here, anything you want to say about how your year has gone, how it's ending, and then what's your outlook, kind of for 2026?
We're really excited about what 25 was for us. I think we've had a really successful year. I think we've grown as a company and we've grown our technology, and our organization has expanded into other products. We've launched 2 new products this year, which are just getting off the ground. So we're excited about that. And then 26 will be more of the same. Vox, I think we're going to start in the UK, Q2 or Q3 next year.
Nice.
So that's exciting for us. We've been approached from some JVs in Central America. So that's exciting for us. And we continue to hone our skills with our brokers, trying to bring in better quality, remove bad quality. I think all funders kind of do the same, and our relationships still continue to grow, and the old ones are the most important ones for us. Getting a lot of deals in your door is one thing. Working with people that you have integrity is something else, and we strive for that.
Well, good. I'm glad you had a great year. A lot of progress. I've seen you guys more and more, and it's always good seeing you at the shows. I'm sure I'll see you at a convention or two coming up here.
I can't wait to see you again. We always put time aside, and we never catch up, but we will.
Yeah, no, for sure. Well, down in Florida has some decent weather this time of year.
Yeah. I'm looking forward to the March and February ones, I promise.
All right, perfect. Well, Lou, appreciate it so much for taking some time today. We'll talk soon, and thanks again.
Thanks, Shane. Appreciate it.
All right.
Bye-bye.
Thank you.